Imagine walking into a bank today and seeing a high yield savings account offering 4.5% interest. For many, this feels like a long awaited victory after a decade of near zero returns that forced savers to take unnecessary risks just to stay ahead of the curve. However, this sense of security is often a sophisticated psychological trap known as the money illusion, where the nominal value of your currency masks the silent erosion of its actual purchasing power. You might see the numbers in your digital dashboard ticking upward every single month, but if the cost of the services you rely on is climbing even faster, your wealth is not actually growing. It is more like carrying water in a beautifully crafted bucket that has 1,000 tiny holes in the bottom, where the more you pour in, the more you realize the ground beneath you is getting wet, while the bucket stays half empty. The recent decision by the Federal Reserve to maintain interest rates between 4.25 and 4.50% is a clear signal that the battle against inflation is far from over. While headline inflation might seem to be cooling down, the underlying service sector inflation remains stubbornly persistent and continues to exert a heavy toll on the average American household budget. When the cost of auto insurance, medical services, and home repairs continues to skyrocket, that 4.5% interest rate suddenly starts to look less like a profit and more like a desperate attempt to mitigate a disaster. This is the hidden reality of our current economic landscape, where the Federal Reserve is forced to play a high-stakes game of chicken with the markets, hoping to dampen demand without triggering a massive collapse in the labor market or the broader financial system. We have been conditioned to believe that higher interest rates are a reward for our patience and a sign of a healthy returning economy for the disciplined saver. But we must ask ourselves who truly benefits when we leave our capital sitting dormant in these institutional vaults, while the real value of that money is being redistributed through the invisible tax of inflation. If you think your bank is your partner in this journey toward financial freedom, you might be missing the most critical piece of the puzzle regarding how modern monetary policy actually functions. The real question we must confront is not how much interest we are earning on our deposits, but rather what is truly controlling the flow of our money behind the scenes. What is actually quietly controlling your wallet while you think you are making independent financial decisions in this high-interest environment? The answer lies deep within the mechanics of the service economy and the Federal Reserve's persistent struggle against what economists call sticky inflation. Unlike the prices of televisions or used cars, which can drop quickly when supply chains stabilize, service inflation is deeply embedded in the cost of labor, healthcare, and insurance. When the Federal Reserve maintains the federal funds rate between 4.25 and 4.50%, they are acknowledging that the core drivers of your daily expenses are not responding to traditional monetary medicine as quickly as hoped. This creates a psychological weight where the cost of living feels like an uphill battle that you can never quite win despite your best efforts to budget every single cent. To understand why we continue to struggle, we must look at the neurobiology of consumption and how modern marketing exploits our ancestral brain chemistry for corporate profit. We often blame our lack of discipline for our financial failures, but we are actually fighting against a multi-billion-dollar industry designed to trigger dopamine hits every time we click a buy button or swipe a credit card. This dopamine economy thrives on the gap between our desire for immediate gratification and our long-term financial health, making it nearly impossible to resist the siren song of lifestyle upgrades even when interest rates suggest we should be saving. It is not merely a personal failing of character, but a systemic design where your natural human impulses are being weaponized against your bank account by algorithms that understand your weaknesses better than you do. Furthermore, we must recognize the profound impact of the wealth effect, which creates a false sense of security among many American households, even as the cost of borrowing climbs to painful heights. Because home prices and equity markets like the S&P 500 have remained relatively resilient despite the aggressive tightening cycle, many people feel wealthier on paper than they actually are in terms of liquid cash flow. This perceived wealth encourages continued spending on non-essential services like luxury travel and premium dining, which in turn forces the Federal Reserve to keep rates higher for longer to cool down the overheated demand. This feedback loop is the primary reason why the economic pain feels so unevenly distributed across the population, leaving many to wonder why the traditional rules of a recession do not seem to apply in this strange new era of expensive money. Ultimately, the root cause of your financial friction is a fundamental misalignment between the objectives of the central bank and the incentives of the consumer-driven world we inhabit daily. While the Federal Reserve is desperately trying to pull the emergency brake on the economy to protect the long-term value of the dollar, every advertisement and social media influencer is pushing you to step harder on the gas pedal of consumption. You are caught in a massive tug-of-war between a government trying to prevent a total monetary collapse and a corporate machine that requires your perpetual spending to satisfy its shareholders. Breaking free from this cycle requires more than just a better spreadsheet. It requires a radical deconstruction of how you perceive the value of your time and your labor in a world that wants to commodify both. As we pull back the curtain on these systemic forces, we begin to see that the real enemy is not the high interest rate itself, but the invisible strings that pull us toward financial mediocrity. If we can identify the biological and economic traps set for us, we can begin to leverage the very same math that currently works against us to build a foundation that is truly unshakable. The realization that you are being manipulated by a combination of central bank policy and neuromarketing is the first step toward reclaiming your financial sovereignty and preparing for the next phase of this journey. Now that we understand the psychological and systemic forces at play, we must look at the actual numbers to see how we can turn the tide in our favor through a specific mathematical shift that most people completely ignore. What core math will completely change your financial game? It starts with recognizing the brutal asymmetry of the current interest rate environment where the gravity of debt is significantly stronger than the lift of your savings. While the Federal Reserve has kept the baseline rate between 4.25 and 4.50%, the average credit card annual percentage rate in the United States often exceeds 20%, creating a sugar-coated mousetrap for the unwary consumer. This means for every dollar you earn in interest from a high-yield savings account at a major institution like Goldman Sachs or Ally Bank, you might be paying 5 times that amount to a credit card issuer on your outstanding balances. The math of the middle class is often a losing battle because we focus on the small gains of our deposits while ignoring the massive hemorrhage of our high-interest liabilities that compound against our future freedom every single day. To reverse this trend, we must understand the mechanics of the money printing machine that wealthy individuals and institutions use to scale their capital over time. When you reach a certain threshold of invested capital, typically referred to as the escape velocity of wealth, the mathematical power of compound interest begins to outpace your daily labor as a primary source of income. If you consistently allocate capital into broad market index funds like those offered by Vanguard or Fidelity, which track the S&P 500, you are essentially betting on the long-term productivity of the entire American economy rather than the static yield of a savings account. Over long periods, the historical average return of approximately 10% far exceeds the current 4.5% ceiling set by the Fed, allowing your assets to double every 7 to 10 years through the rule of 72. This is not magic, but a fundamental law of compounding that requires time and a shift in how you view every dollar as a potential soldier in your private financial army. However, the real math of wealth building must also account for the hidden costs that the Internal Revenue Service and inflation take from your gross returns. If your savings account pays you 4.5%, but the inflation rate for essential services is hovering near 5%, your real inflation-adjusted return is actually negative, meaning you are technically losing ground despite the nominal growth shown on your bank statement. Furthermore, the taxes you pay on that interest income further erode your net gains, which is why sophisticated investors utilize tax-advantaged accounts like the 401k or the Roth IRA to shield their growth from immediate taxation. By understanding these specific mathematical levers, you can stop running on the treadmill of mediocrity and start building a momentum-driven portfolio that grows exponentially rather than linearly. Every financial decision you make should be filtered through this lens of net real return after taxes and inflation have taken their share of the pie. Once you master the basic arithmetic of debt elimination and tax-efficient compounding, you begin to see the financial world not as a series of obstacles, but as a game of strategic capital allocation. The difference between a person who remains trapped in the cycle of paycheck to paycheck living and one who achieves ultimate financial independence is often just a few percentage points of optimized yield and a relentless focus on reducing friction in their financial engine. This mathematical clarity is the foundation upon which true freedom is built, allowing you to stop trading your limited hours for dollars and start commanding your dollars to work for you 24 hours a day. But as powerful as these numbers are, they cannot be fully realized without a fundamental transformation in how you define the concept of wealth itself. This brings us to a deeper realization about the psychological shift required to move from a state of scarcity to one of strategic abundance in a world designed to keep you broke. What is the real difference in thinking about wealth that separates the chronically broke from the truly free? Most people define wealth by the visible artifacts of consumption, such as luxury vehicles, designer clothing, or sprawling estates, but true wealth is actually the invisible gap between what you earn and what you choose to consume. It is the silent accumulation of assets that buy you the most precious and non-renewable resource in existence, which is your own time and autonomy. When the Federal Reserve maintains these higher interest rates between 4.25 and 4.50%, the cost of showing off becomes significantly more expensive because every dollar spent on a depreciating luxury is a dollar that could have been earning a compounding return in a high-interest environment. This shift from a consumer mindset to an owner mindset is the fundamental pivot that separates those who are merely high income from those who are truly wealthy and insulated from the anxieties of the economic cycle. The scarcity mindset is a biological trap that forces us to focus on the immediate lack of resources, which often leads to impulsive decisions that sabotage our long-term stability and growth. When you operate from a place of financial fear, you are more likely to chase speculative gains or fall victim to predatory lending practices because you are desperate for a quick exit from your current situation. In contrast, a strategic mindset treats every financial decision as a move on a global chessboard, where the objective is not to win the current round, but to ensure you are still playing the game decades from now. This involves deeply understanding the concept of opportunity cost, which is the hidden price of everything you choose to do at the expense of something else you could have done with that same capital. For example, $1,000 spent on a new smartphone is not just $1,000 gone, it is the loss of the thousands of dollars that money would have become if invested in a diversified portfolio over 20 years. Building true wealth often requires making decisions that appear poor or unremarkable to the outside observer while you are in the critical accumulation phase of your journey. While your peers might be upgrading their lifestyles to match their rising salaries or taking on debt for social validation, the strategic investor remains disciplined and continues to drive the older car or live in the modest home to maximize their contributions to tax-advantaged accounts. This temporary sacrifice of social status is actually a massive investment in your future freedom because it allows you to build a fortress of capital that can withstand any market volatility or sudden policy change from the Federal Reserve. You are essentially buying your way out of the system of mandatory labor by creating a self-sustaining ecosystem of assets that generates cash flow regardless of whether you show up to a job or not. This is the ultimate form of power in a capitalist society, where the ability to say no to a situation you dislike is the greatest luxury money can ever provide. Furthermore, we must recognize that the modern financial landscape is designed to make us feel inadequate if we are not constantly upgrading our material lives to keep up with the digital facade of social media. The true difference in thinking about wealth is the internal validation that comes from knowing your net worth is growing, even if your outward appearance remains unchanged to the public eye. When the Federal Reserve keeps interest rates at 4.25%, it serves as a powerful reminder that capital has a real cost, and that those who can defer gratification are the ones who will ultimately control the direction of the economy. By choosing to invest in productive assets like the S&P 500 or real estate rather than consumable goods, you are aligning yourself with the growth of human innovation and the compounding nature of global progress. This mindset shift is not about depriving yourself of joy, but about redefining what brings you the most significant and lasting satisfaction in life, which is the peace of mind that comes from true security. Ultimately, the journey toward wealth is as much a psychological evolution as it is a mathematical one, because you must learn to override the primal instincts that crave immediate status and comfort. As you begin to see the world through the lens of strategic abundance, you realize that the fluctuations of the Federal Reserve or the temporary dips in the market are merely noise in a much larger symphony of compounding growth. You no longer react with panic to economic headlines because you have built a plan based on the timeless principles of capital preservation and asset appreciation. This newfound clarity allows you to move with purpose and confidence, knowing that every dollar you save and invest today is a sturdy brick in the wall of your future freedom. Now that we have rewired our thinking, we can move toward the specific and tangible steps that will turn this philosophy into a concrete reality for your personal bank account. Exactly what steps do you need to take right after turning off this video to protect your financial future in this high-interest environment? The first and most critical action is to aggressively attack your high-interest liabilities using the debt avalanche method, which focuses on paying off the balance with the highest annual percentage rate first. While the Federal Reserve holds the benchmark rate at 4.25%, the interest on your consumer credit cards is likely compounding at 5 times that rate, making it a mathematical emergency that cancels out any gains you might achieve in the stock market. You should immediately list every debt you owe, identify the one with the highest interest rate, and redirect every possible dollar toward that balance until it is completely eradicated from your financial existence. This move alone can save you thousands of dollars in interest charges over the next several years and provides a guaranteed return on your money that no investment can match with such certainty. Once your high-interest debt is under control, your second step is to stop letting your emergency fund sit in a traditional big bank checking account that pays near zero interest while the bank earns 4.5% on your deposits. You must move your liquid cash into a high-yield savings account or a government money market fund provided by reputable institutions such as Vanguard or Fidelity, where you can capture the full benefit of the current interest rate environment. These accounts are currently offering some of the highest yields seen in decades, allowing your cash reserves to actually keep pace with the sticky service inflation that the Federal Reserve is working so hard to contain. By making this simple digital transfer, you are effectively giving yourself a raise and ensuring that your safety net is working just as hard for you as you worked to earn the money in the first place. The final and perhaps most transformative step is to remove the human element of emotion from your investing strategy by setting up an automated monthly transfer into a low-cost S&P 500 index fund. This systematic approach, often called dollar cost averaging, ensures that you are buying more shares when the market is down and fewer when it is expensive, allowing you to participate in the long-term growth of the American economy without having to time the market. In a world where service inflation remains persistent and the Federal Reserve is cautious, consistency is your greatest weapon because it allows the power of compounding to take over the heavy lifting of wealth creation over time. By automating this process today, you transition from being a victim of the interest rate cycle to becoming a beneficiary of global productivity, setting the stage for a lifetime of financial independence that is no longer dependent on a single paycheck or a specific government policy. What trap can throw you back to the starting line, and how can you avoid it even when you think you have finally won the game? The greatest danger to your financial survival is not a sudden stock market crash or a policy shift from the Federal Reserve, but rather the slow and insidious poison of lifestyle inflation that often follows any period of economic success. As you begin to implement the strategies we have discussed and see your net worth finally start to climb, there will be an almost overwhelming psychological pressure to reward yourself by increasing your standard of living to match your new income level. This phenomenon, often called lifestyle creep, effectively anchors you to your current job and prevents you from ever achieving the true autonomy that you were working so hard to secure in the first place. You must recognize that every time you upgrade your car, your housing, or your travel habits without a corresponding increase in your investment rate, you are simply building a more expensive cage for yourself that requires more and more labor to maintain. We must return to the image of the leaking bucket that we discussed at the very beginning of this journey because it remains the most accurate representation of the modern consumer experience in a world of persistent service inflation. If you focus only on the nominal interest rate of 4.5% while ignoring the rising costs of your essential services and the expanding scope of your lifestyle, you are still carrying that same leaking bucket through a desert of financial uncertainty. The numbers on your screen may look larger than they did a year ago, but if your monthly expenses have grown at the same rate or faster, you have not actually gained any ground in the race toward true independence. To truly fix the bucket, you must not only fill it with more capital, but also plug the holes of unnecessary consumption and high-interest debt that are constantly draining your future potential before it has a chance to compound. The ultimate goal of this entire process is not to accumulate a pile of digital currency just for the sake of having a high score, but to buy back your freedom from a system that is designed to keep you in a state of perpetual productive anxiety. True security comes from the deep internal knowledge that your basic needs are covered by the assets you have built, allowing you to make choices based on your personal values rather than financial desperation. As interest rates eventually begin to fluctuate and the economic headlines shift to the next crisis, the person who has mastered their own psychology and understood the basic math of compounding will remain calm while others panic. You are not just managing money. You are managing your own life and ensuring that your future self has the options and the dignity that only a solid financial foundation can provide in an increasingly volatile world. Be wary of the moments when the economy seems to be thriving and the pressure to join the crowd in reckless spending is at its peak, as these are often the moments when the most devastating financial mistakes are made. The trap of social comparison is a bottomless pit that can consume even the largest fortune if you do not have a clear understanding of what enough looks like for your specific goals and aspirations. By maintaining your discipline even when those around you are losing theirs, you position yourself to take advantage of the opportunities that inevitable market corrections will provide to the prepared and the patient. Remember that the Federal Reserve and the big banks are playing a game that is designed to favor the house. But by opting out of the consumer cycle and into the owner cycle, you are finally playing a game that you can actually win. The journey toward financial sovereignty is a marathon of the mind that requires a relentless commitment to the truth over the comfortable illusions of the crowd. As you move forward from this moment, carry with you the understanding that your time is your most valuable asset, and that every dollar you save and invest is a step toward reclaiming your life from the forces of inflation and debt. The road may be long and the distractions many, but the reward of true freedom is worth every temporary sacrifice and every moment of disciplined focus you invest along the way. Your financial destiny is not written in the meeting minutes of the Federal Reserve, but in the daily decisions you make about how to allocate your capital and your energy in pursuit of a life that is truly your own. The numbers will change and the policies will shift, but the principles of human psychology and the laws of compounding remain eternal. Stay focused. Stay disciplined. And remember that wealth is not what you spend, but the freedom you keep.